Welcome to The Explainer. Have you ever wondered how a huge company decides to, say, build $1 billion factory or launch a product that changes everything? Well, it's definitely not guesswork. Today, we're going to crack open the financial toolkit they use to make those massive, high-stakes bets.
Okay, let's start with a situation pretty much every business leader faces. Imagine you are the boss. You've got two amazing projects on the table, but you only have the cash for one. So which one do you pick? Choose right and you're a hero. Choose wrong, and that could be a multi-million-dollar mistake. That's exactly why the tools we're about to cover are so important.
You know, making these huge calls isn't about flipping a coin or just going with your gut. The pros use a structured analytical process. It's like they have this special toolkit full of financial techniques that are designed to solve these massive complex puzzles and hopefully find the most profitable way forward.
So here's our game plan. We'll start by really framing that big decision, and then we're going to unpack that powerful toolkit. We'll dive deep into three essential tools: the payback period, net present value, and the internal rate of return. And then, at the end, we'll see how you bring it all together to make the right call.
All right, let's get into it. This whole professional toolkit for making these big investment choices actually has a name. It's called Capital Budgeting Evaluation. It's really just the formal process of analyzing potential projects to figure out which ones are actually worth the money. Now, inside this toolkit, there are a bunch of different instruments. We're going to focus on three of the most powerful and common ones. And what's cool is that each one answers a slightly different but super important question about any potential investment. First up, let's grab our first tool, the payback period. If you think about investments kind of like a race, then this tool is the stopwatch. It's all about one thing: speed. So what is it exactly? Well, the payback period answer is one really simple but crucial question. How long until we get our initial investment back? That's it. It's a measure of time, usually in years. Let's make this real. Say a bakery spends 50 grand on a new delivery truck. They expect it to bring in an extra $20,000 in cash each year. Okay, so after year one, they've gotten $20,000 back. After year two, they're at $40,000. They just need another $10,000 to break even, right? Well, since they make $20,000 a year, that'll take half of year three. So the payback period is 2.5 years. Simple. Now, this tool has a really clear trade-off. On one hand, it's super simple to understand, and it gives you a quick feel for risk. I mean, the faster you get your money back, the less risky it feels. But, and this is a big but, it has major flaws. It completely ignores any money you make after the payback point, and crucially, it doesn't account for the time value of money. This idea that $1 today is worth way more than $1 tomorrow. So the bottom line is this. The payback period is great for a quick look at risk and how fast you can get your cash back in your pocket. But because it's so short-sighted, it should never be the only tool you use to make a decision. Okay, let's move on to our second tool, which gives us a much more complete and honestly smarter picture. This one is called Net Present Value, or NPV. And it asks a much more powerful question. What is this project really worth to the business in today's money? See, NPV is all about that fundamental idea, the time value of money. $1 in your hand today is worth more than $1 you get a year from now, because you could invest it. So NPV takes all the future cash a project is going to make, discounts it back to what it's worth today, and then subtracts the initial cost. If that final number is positive, you've got a winner.
Okay, let's go back to our bakery truck. It seemed like a pretty good deal with the payback period, didn't it? Well, watch what happens when we use NPV. Let's use a 10% discount rate. You can think of that as the minimum return the company needs to make. We take each year's $20,000 and figure out what it's worth today. And when we add it all up, whoa, the total NPV is actually negative $263. This project that looked good, it actually loses the company value.
And that right there shows you the power of NPV. It gives you a hard dollar amount that a project will add or subtract from the company's value. It considers everything. The only real catch, it's a bit more complex, and that final answer is super dependent on getting that discount rate right. If your assumption there is wrong, your whole analysis can be way off. So the key takeaway here is pretty simple. NPV is really considered the gold standard by a lot of finance pros. Why? Because it directly answers the most important question. Does this make the company more valuable? A positive NPV means you're making the owners of the business richer. Period. All right, let's move on to our third and final tool, the internal rate of return, or IRR. Now, if NPV gives you a dollar value, IRR gives you something that's often even easier to wrap your head around: a single, powerful percentage. Now, the technical definition can sound a little confusing, but the idea behind it is actually pretty straightforward. IRR basically tells you the project's true, built-in rate of return. You can think of it like the interest rate you're earning on that specific investment. And the decision rule is super simple. If the project's IRR is higher than your cost of capital, what you pay to borrow money, then it's a good investment.
You know, managers tend to love IRR because, well, everybody understands percentages. It's so easy to say, hey, this project has a 20% return and our cost of borrowing is only 8%. But it does have some quirks. It can sometimes give you weird answers for projects with unusual cash flows, and it can be a little misleading if you're comparing a tiny project with a super high IRR to a massive project with a slightly lower but still really good IRR.
So to sum it up, IRR is a really compelling metric. It boils down a project's profitability to a single percentage, which makes it incredibly easy to compare against other opportunities.
Okay, so we have three different tools. Payback measures speed, NPV measures the total value in dollars, and IRR measures the percentage return. But what happens when they give you different answers, kind of like our truck example did? How in the world do you make that final call?
This right here is probably the most important part. You don't just pick one favorite tool and ignore the others. A really smart analyst uses all of them to build a complete 360-degree view. You start with payback to get a feel for the risk. You calculate the NPV to see the real value being created. Then you find the IRR to understand the return. You put all three pieces of the puzzle together to make a truly informed decision.
And this really is the core lesson here. Each of these tools is like a different lens for looking at the same project. If you only use one, you're getting an incomplete picture. It's like trying to build a house with only a hammer. No way! You need the full toolkit to make the best, most solid financial choice.
Let's just say it one more time to lock it in. Payback is about speed, how fast you get your cash back. NPV is about value, how much richer this makes the company in today's dollars. And IRR is about return, the percentage you're making on your money. A truly great decision finds a project that looks good from all three angles.
So I'll leave you with this final thought. Now that you've seen what's inside the toolkit, the next time you see a news headline about some company launching a massive new project, you can think like a real financial analyst. You can ask yourself, did they just pick the project with the quickest payback? Or did they do the deep analysis to find the one that creates the most real long-term value? Did they just choose the fastest option, or did they choose the smartest one?